Saan nga yung ano dito?
Yes, sir.
Yung background.
Good morning, Dr. Llanto. Quick sound check.
Morning.
All right, thank you.
Liwanag.
Yes, sir.
Hello.
Sir.
I'm testing. Hello.
Yes, sir. Okay. Good, sir. Thank you.
Mr. Beta. It's okay.
Good tayo, sir. Okay.
dapat po munang alamin or matukoy ang pangunahing problema ng bansa upang mapagtuunan ng pansin at mabigyan ng solusyon.
We should have specific goals, do research, and make a policy that is fair for everyone.
Walang problema sa pulisiya. Iayos lang ang pagpapatupad.
Bago patubas ang batas, pag-aralan muna gusto ng government.
Two things, clarity and execution. Both, you need the communication and monitoring. As simple as that.
Mandato ng Philippine Institute for Development Studies o PIDS na gumawa ng mga pag-aaral at pananaliksik ng mga pulisiya at programa ng pamahalaan at magbigay ng rekomendasyon sa mga mambabatas sa pagbabalangkas ng mga pulisiyang makakatulong sa ating bansa. Sinusulong ng aming ahensya ang evidence-based policy making upang bigyan diin ang kahalagahan ng pulisiya na batay sa datos at policy research na sumusuri sa tunay na kalagayan ng ating mga komunidad. Napakahalaga ng policy research, lalo na sa mga panahong dumadaan sa krisis ang ating bansa.
Kapag pulisiya ay pinag-aralan, susulong ang bayan.
Good morning, ladies and gentlemen. A sincere welcome to this morning's event, the BSP PIDS Research Forum entitled Resilient Legs for Economic Recovery in the Post-Pandemic Era. We have a remarkable lineup of speakers and discussants who will cover a variety of topics ranging from labor productivity, financial inclusion, and foreign direct investment. Without further ado, let us now listen to the opening remarks of the Honorable Benjamin Diokno, Chairman of the Monetary Board and Governor of the Bangko Sentral ng Pilipinas.
Dr. Aniceto Orbeta Jr., PIDS President, our paper presenters, distinguished discussants, colleagues from the BSP, PIDS, other government agencies, and private institutions, ladies and gentlemen, good morning. The pandemic has disrupted the global economy in many ways. The contraction in real output activity last year was unprecedented, despite the magnitude and speed of policy responses by governments around the world, including the Philippines. The crisis is unique in the range of its impact across various sectors, countries, or regions. The complex transmission channels, diverging prospects, and the manner and speed of recovery. The extent and persistence of the damage to potential output, now widely termed as scarring, will differ across countries amid varying policy responses. Attempting to estimate the macroeconomic impact of COVID-19 is a daunting task. According to a working paper by the IMF, the various possible scenarios about the global economic landscape and government policy post-pandemic have discouraged foreign direct investments and human capital accumulation due to disruptions in education. Huge losses have also been observed in global supply chains. Amid weakened fiscal position and higher debt in many economies, structural and institutional reforms will be critical to jumpstart economic recovery. A comprehensive package of reforms is vital to help reverse the expected impact of the pandemic on the long-term growth prospects of emerging markets and developing economies. In the Philippines, the BSP acted swiftly to support the economy during this critical time. It implemented three major categories of interventions. First, we have put in place measures to boost aggregate demand through appropriately accommodative monetary policy. The BSP reduced its policy rate by a total of 200 basis points to help bring down the cost of borrowing and shore up market confidence. At the same time, it lowered reserve requirements by 200 basis points to increase the volume of loanable funds. In addition, it allowed banks to count new loans to micro, small, and medium enterprises and large enterprises as alternative compliance to the reserve requirement. Second, BSP adopted extraordinary liquidity measures. These include purchases of government securities in the secondary market and provisional advances to the national government. In total, the BSP has infused about 2.2 trillion pesos in liquidity, equivalent to 12.5% of the country's gross domestic product for 2020. Third, BSP implemented regulatory and operational relief measures to maintain the stability of the financial system and ensure smooth access to financial services. It issued time-bound and targeted regulatory and operational relief measures to encourage BSP-supervised financial institutions to continue their support to the economy, with particular emphasis on the MSME sector. We promoted financial digitalization and made strides towards green finance as part of our vision of a post-COVID-19 economy that is greener, more resilient, more technologically advanced, and more inclusive than ever before. A year and a half since the onset of the COVID-19 pandemic, we are seeing concrete signs of economic rebound. The accelerated vaccination rollouts, granular lockdowns, and the continued implementation of health safety protocols have allowed the Philippine economy to gradually reopen for workers to regain their jobs. Growth has gained traction with domestic GDP expanding at 11.8% in the second quarter of 2021, after 5 quarters of pandemic-induced contractions. At the BSP, we stand by the Development Budget Coordination Committee's revised forecast of 4 to 5% growth this year and 7 to 9% growth next year. The theme of our research forum today, quote, "Resilient Legs for Economic Recovery in the Post-Pandemic Era," is very appropriate as we endeavor to highlight areas that could contribute to more inclusive and resilient growth in the Philippines in the aftermath of COVID-19. It features 3 relevant research papers from the BSP Research Academy and the PIDS. The first paper is about Philippines IT-BPOs, which have remained resilient amid the pandemic. The industry holds much promise in terms of moving up to higher value-added activities in the global supply chain of business services. The second paper discusses financial inclusion and how it can help create opportunities for Filipinos to improve their lives and participate in the formal sectors of the economy. In a report titled Global Microscope 2020, the role of financial inclusion in the COVID-19 response by the research arm of the Economist Group, the BSP was recognized for its initiatives to mitigate the adverse economic impact of the current health emergency via its financial inclusion initiatives. The third research points out how in 2020, FDI flows plunged globally by 35%, the biggest decline recorded since 2009 as a consequence of the COVID-19 pandemic. Lockdowns, supply chain disruptions, falling corporate earnings, economic uncertainties, and delayed investment plans were the primary reasons for the contraction. understanding the determinants of the FDI decline could help us design the appropriate policy responses that would attract more FDIs and spur post-pandemic recovery. At this point, allow me to thank the PIDS for our research collaboration. As you know, our institutions agreed to jointly work to deliver quality, relevant, and rigorous research that would support policy formulation in the country. And we welcome this research fora as a meaningful venue to communicate and disseminate research findings and recommendations to be effectively and appropriately used as inputs to policy formulation and implementation moving forward. Thank you, and I wish everyone a productive and meaningful discussion ahead.
Now, ladies and gentlemen, just a few quick notes on today's event. House rules were flashed earlier, but most pertinently, in order to ensure a fruitful experience for everyone, we request attendees to have their microphones on mute and video cameras disabled throughout the webinar. Recording, reposting, or rebroadcasting parts of the proceedings are not allowed without prior approval from the Philippine Institute for Development Studies and the BSP Research Academy, as well as concerned authors. With that taken care of, I am honored to introduce our roster of speakers and discussants, beginning with Dr. Laura Britt Fermo, a senior researcher of the BSP Research Academy, Dr. Felipe Medalla, Monetary Board member of the BSP, Dr. Margarita Debuque-Gonzales, Senior Research Fellow of the Philippine Institute for Development Studies, Dr. Gilberto Llanto, former President and current Board Trustee, PIDS, Dr. Hazel Parcon-Santos, Senior Researcher of the BSP Research Academy, and Dr. Myrna, Austria, University Fellow and Professor de la Salle University. We'll get to know them a bit more intimately as we go through the three papers scheduled. But for now, may I request the speakers and discussants and Dr. Orbeta to participate in our ceremonial screenshot by turning their video cameras on. Our staff will be taking a few screenshots. So let's just make sure everyone is online. 1, 2, 3, 4, 5, 6. So when I count to 3, I suppose we will take a few shots. In 3, 2, 1. Oh, okay. So that was just a practice shot. So we'll okay. So I hear the ready cue. So in 3, 2, 1. All right. So I guess we were good with our souvenir shots. So thank you, everyone. And now we again welcome Dr. Laura Britt Fermo for our first paper entitled Labor Productivity, Real Wages in Services, and the Growth in IT-BPMs in the Philippines. Dr. Laura Britt Fermo, or Laura as we know her in BSP, has been with BSP since 2006, building a rich career for various departments, including the Center for Monetary and Financial Policy, the Department of Economic Research, Office of Systemic Risk Management, the Office of Monetary Board member Felipe Medalla, and now, of course, the BSP Research Academy. Her extensive experience also involves work for the Asian Development Bank and the San Miguel Corporation Corporate Planning Office. She obtained her undergraduate degree in economics from the University of the Philippines School of Economics at the University of the Philippines, Diliman. She obtained her PhD in economics from Keio University of Tokyo, Japan, and was the first ever recipient of the Japan Society for the Promotion of Sciences Ronpaku PhD by Dissertation Scholarship, who graduated with a PhD in pure economics in the Philippines. Her discussant is none other than Dr. Felipe Medalla, a member of the Monetary Board of BSP since July 2011. Before he joined the Monetary Board, he was professor at the University of the Philippines School of Economics, where he has served as dean for 4 years prior to his appointment as a member of the cabinet under President Joseph Estrada as Secretary of Socio-Economic Planning and Director General of the National Economic and Development Authority. He was a member of the Presidential Task Force on Tax and Tariff Reform under the administration of President Fidel Ramos and was president of the Philippine Economic Society in 1996. He was chairman of the Foundation for Economic Freedom, a non-government organization that is primarily engaged in public advocacy for fiscal reforms and market-friendly government policies. He has written on the effects of economic policies and poverty and problems in the measurement of Philippine economic growth, among others. Dr. Medalla got his PhD in economics from Northwestern University in Evanston, Illinois, and has an MA in economics from the University of the Philippines. He graduated cum laude from De La Salle University with a Bachelor of Arts and Bachelor of Science in Commerce, Economics, Accounting degree. So the next half hour promises to be very enriching for all of us. So Dr. Fermo, or Laura, as we all know her, please take the floor. Laura, good morning.
Hi, good morning, Jed, and good morning, ladies and gentlemen. First of all, thank you, Jed, for the kind introductions. At the same time, I'd like to thank all the participants and attendees, as well as my co-panelists, for the time you have shared to attend this BSP PIDS collaborative effort. So let me share my PowerPoint presentation for today. Oops, I think I shared the wrong one. Let me do that again. Please bear with me. Is that the correct slide? Just a minute. One last try. Screen 2, there you go. And share. Can you see my slides,
Yes,
Jet?
yes, we are able to see your slides, Laura. Thank you.
All right, great, thank you. So just to begin the presentation, again, I'm presenting today the initial findings from a research study on labor productivity, real wages in services, and the growth in IT-BPMs in the Philippines. I share this research with two other co-authors, my colleagues from the BSP Research Academy, who are also with us today, Dr. Hazel Parcon-Santos and Mr. Jose Santo Domingo, our very own moderator. So to begin, and as an introduction, let me put the IT-BPM into proper perspective as a player in the global value chain for business services. Unprecedented globalization has led the production of both goods and services being broken down into several tasks across countries. This trade in tasks is what is denoted as global value chains, or GVCs. With the advent of the internet and the rapid advancements in the sphere of communication and technology, multinational enterprises are able to outsource routine or non-core office functions to developing countries, thus giving rise to BPOs. In this next slide, I'm showing you a diagram that gives us the workforce composition across three different GVC categories. The first box depicts low technology manufacturing GVCs, which involves a relatively large share of low-skilled labor-intensive work requiring limited education requirement. And this is true for many apparel export GVCs. The second box represents medium and high technology manufacturing GVCs, which would involve a relatively large share of middle-skilled mixed production technologies and high-skilled technology-intensive work, requiring very specific technical competencies. The best example for this category are the GVCs in automotive manufacturing and electronic and electrical machinery GVCs. This is in fact where Philippine semiconductor assembly and electronics and electrical machinery in many earlier export processing zones fall under. The third box on knowledge-intensive GVCs, characterized with a large share of knowledge-intensive work, requiring specialized knowledge and specialized skills, and usually tertiary degree level of education, is where business process outsourcing, and knowledge process outsourcing fall under. BPO operations encompass call centers or voice services and higher value non-voice BPO functions. Earlier on, voice services cover most call center operations outsourced into the Philippines, which involve either calling the customer located abroad, which are called outbound accounts, or receiving calls from the client or inbound accounts. These are activities that tend to focus on direct customer care. The Philippine workforce has unique comparative advantages from other offshore service providers in terms of low labor costs, English proficiency, high skills, and cultural adaptability and compatibility that made it a perfect destination for call center services at the onset, particularly so for customer care. Fiscal and non-fiscal incentives from the government also provided support to maximize on these advantages. Information and communication technology innovation over the years have increased, and the increasingly fragmented production processes have encouraged the outsourcing of labor-intensive business services to developing countries, such as the Philippines and India, two countries which have become the leaders for offshore business services worldwide because of each of their own comparative advantages. The sector's competitiveness in BPO services is clearly manifested into how the Philippines has been faring well in global rankings. The Philippines was named the offshoring destination of the year by the UK's National Outsourcing Association 3 times in 2007, 2009, and 2010. By 2010, in fact, and I think this is popular knowledge by all, the Philippines was named the call center capital of the world. This was from the IBM Global Location Trends Annual Report, which released in October 2010, that the Philippines had become a leader in shared services for outsourcing in the world, outranking India. Based on AT Kearney's Global Services Location Index, the Philippines ranked consistently as top 7 among 50 countries between 2014 to 2017. And in fact, in 2017, the report named the country as industry leader. In the more recent 2018 Tolan Services Globalization Country Index, the time series for which I'm showing to you here in this slide, the Philippines ranked second next to India in the top 50 digital nations in the world. In 2020, however, the latest report, 4 developed economies overtook developing countries. So I note that developed economies have overtaken developing countries like the Philippines in the top 10 rank. It is important to note that the 2020 index for this report has a much higher emphasis on digital innovation attributes and the assessment of how the various cities and currencies have managed and are winning over the global crisis during the pandemic. And this is worth noting as probably the main reason why the change in the ranking composition. Now, with all of these developments in the IT-BPM industries, and at the same time in response to the recent global trends and challenges brought on by the demands of automation or higher automation in many industries, the Philippine IT-BPM industry has begun to move towards back office or shared services functions, professional services like legal, architecture, and engineering consultancy, health and medical services, and corporate functions like pricing and data analytics, and extensive social, digital, and creative functions. So mainly, there is a move towards coming from business process outsourcing into information technology outsourcing, and finally into knowledge process outsourcing or KPOs. In fact, when you look at the number of firms comprising the IT-BPM sector, now I'd like to also in parallel point out that there are 3 data sources and 3 different classifications for the IT-BPM sector. Coming from the BSP survey in 2013, the last year that the BSP has conducted the survey before passing it over to the PSA or the Philippine Statistics Authority. The IT-BPM sector registered a total of 1,098 firms. As of August 2021, the Philippine Export Zone Authority, another source, is reporting that there are now 1,403 firms as of August 2021. But what is more important in this diagram is that historically, contact centers had the biggest share in terms of the number of companies. Contact centers rose from 232 in 2013 and to 369 as of August this year. However, we would notice that KPOs, or knowledge process outsourcing businesses, began to dominate the industry, followed only by software development. As of August 2021, other BPO subsector, which include IT-enabled services, engineering, architectural, and other design services, as well as IT research and development, is the subsector with the highest number of companies and which had the biggest increase from 417 companies in 2013 to 594 companies as of August 2021. So clearly, at least in terms of the number of firms, there is now a move towards more KPOs than before. So let me now move towards explaining or discussing with you the main research question that we would like to address in this study. The industry's current level of maturity is showing movement into higher value-added services, moving into ITOs and KPO segments in terms of employment share, the number of firms, and even in terms of the share to total revenues, and various public-private efforts towards reskilling and upskilling. These are indicating that the industry has begun to go up the value chain, managing entire business processes of clients, and not merely outsourcing them over cost considerations in voice call center services alone. Given that the main comparative advantage of IT-BPMs is in terms of human capital, which I mentioned earlier, that is low labor cost, highly skilled workforce, English proficiency, and culture compatibility and adaptability, it is only as important for us to find out and understand does the sector's growth have any impact on labor productivity and real wages? This is the research question we wish to tackle in this study because labor productivity and real wages are important variables in human capital. Now, I have prepared several charts showing stylized facts about the sector. However, I think I would need to skip them for now because of time consideration. So let me jump, maybe just flash these charts very quickly and go straight to the theoretical framework that we have set up or we have referred to in trying to understand how we can provide the answer or obtain the answer for the research question at hand. The literature provides several mechanisms to explain the linkages between real wages, productivity, and output of industries that are linked to global value chains. Traditional theory suggests that productivity determines real wages. Under the marginal productivity theory, a firm would be willing to pay a productive worker up to what he adds to the firm's output. Other papers point out, and truthfully so, that the evolution of wages is not only influenced by labor productivity, but also by other factors. For example, unemployment and workers' reservation wage. So the relationship is shown to you here in terms of these variables. And basically, it's just saying that its relationship with YT, which is labor productivity, the reservation wage R, and U, unemployment. The coefficient for labor productivity is expected to be positive, as suggested by the marginal productivity theory. Meanwhile, the coefficient of the unemployment rate is expected to be negative. However, other theories argue that the causality goes from real wages to productivity. There are two papers that we are citing for this relationship. According to the efficiency wage theory, a firm that pays market clearing wages will find its workers providing minimum effort, but a firm that pays wages above market clearing levels could induce workers to increase their efficiency or productivity. Shapiro and Stiglitz showed that higher real wages increase the cost of jobs, job loss, or dismissal of workers. Thus, workers exert an effort level which involves no shirking. Meanwhile, Akerlof argued that the labor contract is a gift exchange, where a firm is willing to give a gift of paying above market clearing wage, and in return, workers are expected to give a gift of taking on more responsibilities and initiative, and of being loyal to the firm. Now let us go and look at what we find in the literature in terms of the relationship between output and productivity. Mainly, a lot in the literature are indicating that the relationship between output and productivity can be traced through exports. So we can understand how output growth would translate to higher productivity when it is via higher export growth. Export-led growth models stress that exports are a key factor in promoting productivity, and there are several papers that show this, and several channels by which these are achieved, as I'm indicating in these bullets. Other theories suggest that more productive firms self-select into export markets by nature. Now let's try to look at the empirical literature that can be relevant, that are in fact relevant to the research study we are understanding at hand. On sectors in GVCs and productivity, there are several studies in the literature that utilize different empirical approaches. But Nayak and Chadha use a fixed effects model from 2001 to 2016 and found that experience gained over time may lead to increased productive efficiency. Urata and Bayek in 2019 employed OLS and two-stage least squares on the manufacturing data for 47 countries and established that the benefits of GVC participation to total factor productivity growth is positive. Kumritz demonstrated that higher GVC participation also led to higher labor productivity. Lastly, Asada in 2020 for Vietnam had reached the finding that labor productivity has a positive relationship with FDI, capital goods imports and exports. And they have used ARDL bounce testing on data from 1990 to 2017. In terms of sectors in GVCs and wages, there are also several studies that have been done. So basically, higher engagement in GVCs lead to higher wages for workers, according to Pamiwanat in 2019. Meanwhile, Parteka and Wolzak-Derlax in 2019 found an inverse, though weak, relationship between GV participation and corresponding wage levels. Baldwin and Yan for Canada saw that for 2000 to 2006, GVC participation paid higher wages. So what is the empirical approach that we have selected for this study? In our quest to provide an answer to the research question at hand, and in our quest to use an objective empirical approach, we have chosen the use of autoregressive distributed lag model estimation. ARDLs are standard least squares regressions that include lags of both the dependent variable and explanatory variables as regressors. ARDL models have been used for decades, but they have gained popularity in around 2001 because it is a method of examining co-integrating relationships between variables through the work of Pesaran and Shin and Pesaran, Shin, and Smith. The ARDL model is used to estimate relationships between economic variables in a single equation time series setup. The ARDL model is also useful both for forecasting and in disentangling long-run relationships from short-run dynamics. And given our data limitations, one of the advantages of the ARDL test is that it is more robust and performs better for small sample size of data, which is suitable for this research. Additionally, the conjugation of non-stationary variables in the ARDL process is equivalent to an error correction model. So it is easy to reparameterize the model into an error correction form. Now, I already mentioned very briefly in our discussion of the approach used, the empirical approach used, that there is some data limitations. Now, the available sample that we have at hand for the study and considering the variables we have identified for this research is only annual data from 2007 to 2020, relatively a sparse time series data for any empirical study. However, we still continued and performed the ARDL estimation process with the data that is available to us. A main source of our data for this study is ADB's multi-regional input-output tables, or MRIOT, as it is shortened or acronym. This, the ADB's augmented input-output tables is coming from the world input-output tables, but with the addition of 19 economies for the years 2000 and then from 2007 to 2019. And this is mainly why, the most recent published report for the embryo tables is as of 2020, and that is why we were able to use this in our estimation. In addition to the ADB embryo tables, we are also using data from the PSA for employment, mainly for employment, for real wages in services, and some information on the IT-BPM sector. However, data on the IT-BPM sector in particular, which is coming from the annual survey of business and industries of the PSA, only began in 2013 when the BSP has passed over the survey to the PSA, and the latest data for which is as of 2017. So from the ASPBI, we have only 5 years of data. And this is also another reason why we have decided to make use of the embryo tables. But even more important than that, we have chosen the ADB embryo tables because it represented a sort of corrected value-added estimation, whereby a more accurate accounting of the intermediate inputs going into one country and being exported as another part of the process in the global value chain is being accounted for more truthfully. So in fact, GVC analysis points to a case of double counting in export earnings and hence underestimation in bilateral trade deficits. And this is one main reason why we observed that some of our top exports are also our top imports, being a participant in GVCs. We are also utilizing BSP data from the BPO survey for older data and IBPAP for the newer data when it comes to FDI, revenues, employment, and compensation. Lastly, we are getting data on enrollment and graduates in ICT and BPO courses from TESDA and UNCTAD for labor force human capital index data. Just very quickly, I wanted to point out that therefore, in terms of identifying what subsectors are to be included in our estimation, we have identified these 4 subsectors within the ADB embryo tables, which include telecommunications, financial intermediation, real estate renting, and other real estate renting and business activities. Now, this is how the data would look in this chart, but let me again move to the next slide for time considerations. Now, what is important to point out is that in making use of the ADB embryo tables data, note that we have selected 4 IT-BPM related sectors. This is not an exact extraction of the specific IT-BPM sectors as granularly as we would want to. Looking at, for example, the PSA's data from the annual survey of Philippine business and industry, it has a very different composition, and there is a need to look into this more granular data. However, it would have been more ideal for us to make use of the data coming from this survey. However, again, they only have 5 data points for GVA, for gross value added, as well as for employment. But again, in terms of the national income accounting, gross value added data, and the employment by industry classification data from the Philippine Statistics Authority, we find that the 4 sectors that is closely is a close enough approximation of the IT-BPM sector would include information and communication, financial and insurance activities, real estate and ownership of dwellings, and professional and business services. If you remember, this is very similar or very close to the subsectors we are also we have also identified from the ADB and RIO tables. Let's now, I will now proceed with the presentation of our preliminary results. Before I present our initial findings, I would like to just take note of 2 main caveats, as these results are highly preliminary. First of all, please note that the study is still a work in progress. And so we have a few steps that we need to do to refine the estimation we have undertaken for this study. First of all, although we have considered the ARDL bounds testing and have identified which among the variables have a long-run co-integrated relationship, in the table I'm showing you here, the co-integration present for these variables as dependent would be labor productivity for models 1.1 and 1.2, and for models 2.1 and 2.2, where real wages are the dependent variables, the co-integration present is only there when we consider the value added from the embryo tables as the dependent variable. Now, the next step that has to be done, that we are still about to conduct for this study, is to set up the error correction model for these 2 variables and the co-integrating relationship that we have found via the ARDL bounds test. Initially, what we are showing here are the short-run ARDL estimation results. Secondly, the second caveat is that there is definitely a need to obtain better productivity measures. What we have used here is the gross value, the value added data from the ADB and RIO tables divided by the employment data by industry classification coming from the PSA. Again, I have noted to you earlier that this is an identification that we have made based on which subsectors we feel were the close approximation to IT-BPM related sectors, but it is not a direct extraction from the input-output tables. Current productivity estimates as a result may be biased due to measurement issues. Simply defined, productivity is the amount of real output produced by a given set of real inputs. This implies that the quantity of output and inputs, as well as the prices used to deflate both components must be captured accurately. At present, we were still unable to do this, and especially so given the inherent characteristic of services. Nevertheless, we have begun a proposal to collaborate with the Asian Development Bank, headed by Mr. Joseph Maria Singham, who is the lead economist for the ADB and RIO tables, and have sought their assistance for extracting labor productivity estimates and have a more granular subsector classification identifying strictly all IT-BPM subsectors from the IO tables. That said, this is what our preliminary results tell us. First of all, The growth in output of the IT-BPM sector is a positive determinant of labor productivity and of real wages, except in one of our models, which is Model 2.2. Secondly, labor productivity is also a positive determinant of real wages, meaning higher labor productivity leads to higher real wages. The exchange rate has a positive contemporaneous effect in Model 1.1, but in lagged values, the results can be either positive or negative. FDI in IT-BPM has a small positive effect on real wages as a fixed regressor, but a small negative effect on labor productivity. This will be interesting to discuss in the open forum later on. Lastly, enrollees and graduates from TESTA's ICT and BPO courses has a positive impact on labor productivity and real wages. Oops, just a minute. Let me go back. So to conclude, given the positive impact of IT-BPM output growth and ICT BPO education and training on labor productivity, the Philippine IT-BPM sector appeared to have the opportunity to improve labor productivity further, mainly via upskilling and human capital investment, and within the short to medium term. This is a call and the result from several studies in the literature, both from international institutions and domestic institutions alike. Promoting STEM education and reskilling and upskilling is a key result and an urgent call for all of these studies. Higher productivity could help move up the sector in the global value chain in business services, and this in turn ensures the industry's competitiveness in the post-pandemic era. I'm showing here in the last slide a revealed comparative advantage chart based on the ADB and RIU table computations, and they portray how much RCA has been lost by the Philippine electronics export sector. This is falling under the medium to high technology manufacturing, and this is the red line as we see here in this chart. Surprisingly, this was the fall in that sector was compensated for in almost mirror image by RCA gains in the Philippine ICT business services. This is where IT-BPMs belong in the ADB and RIU tables, and which we have considered in the estimation. And this is the light blue line in this chart. So again, based on revealed comparative advantage, it is indicating that the opportunity is there to move up higher into higher value chains for the IT-BPM sector. But this relies heavily on higher investments in human capital. Thank you and good morning.
Dr. Felipe Medalla, Monetary Board Member, sir. Good morning.
Well, first of all, I'd like to congratulate the authors for what I consider to be relatively new findings. At the same time, there are many things to be wary about because it's hard to tell the difference between, let's say, a rise in wages that's due to competition for workers or a rise in wages because of changing composition of skills. I think this is the major problem of the study. For instance, the somewhat puzzling effect that FDI has a small positive effect on real wages, but a small negative effect on labor productivity. We could be observing two things that are going on. The first one is as FDI rose, you have essentially labor shortages. Therefore, the result is higher wages. However, the other possibility is that the early FDIs went for the low-hanging fruits, where the advantage of the Philippines was higher. And later FDI was going after less areas where the Philippine advantage is weaker, which would mean falling, which would give an appearance of falling labor productivity. So my advice is, as much as possible, to look at smaller sectors that are more or less similar over time, and see whether these effects would still happen. The other important point is that changing composition of the IT could lead to higher wages if the changing composition is a rise in the higher value added, higher quality jobs. Let's say more IT related. For instance, in one of our stakeholder awards that we did for BSP, I happened to be seated right next to the head of the Philippine part of Safeway Albertsons supermarket chain in the US. And I asked him why say they're here in the Philippines, and he said the reason they're here in the Philippines is that a Filipino is working for the IT department of Safeway and Albertsons, and he thought that they could do a better job and much more cheaply in the Philippines. And as he described it, it is a very highly skilled undertaking because, in fact, the combination is quite rather remarkable because the management head is from Ateneo, I think the honors program for management, and the IT head is from the computer science department of UP. So you'd see that if you mix these things up with contact centers and things like that, you may get trends that are related more to changing quality of the workers rather than productivity or wage or changes in real wages. Nonetheless, I think it's quite intuitive that the greater the FDI, the greater the problem of shortage of workers, which indeed we do read from the newspapers. So it could be that what FDI that the FDI growth is resulting in higher wages is a good thing, because that means, well, it's both a good thing and a bad thing. That means that there's greater demand for workers and naturally wages rise. The other possibility is, of course, the supply of this kind of workers is also quite limited. And maybe the best policy prescription is how to increase the supply of such workers. Finally, I think quite important is the contribution of the sector to total factor productivity is an interesting topic in its own right. And one thing you will notice in the studies here is the rise in total factor productivity was largely due to falling incremental capital output ratios, meaning you need less and less capital to employ more people and generate more value added. And I think the BPO industry is probably one big contributor to this. Meaning you have a sector that's able to employ a lot of people without using a lot of capital stock, and this would raise productivity to because you'll have the introduction of these industries will result in reallocation of labor away from sectors that would have paid them much lower wage if the new activities had not happened. Okay, so So I think my call for is maybe a cooperation between BSP and PSA to be at least if the researchers are able to look at the worksheets of a PSA, and they could somehow find a better detailed information about the impact of the sector on GDP. Well, of course, that's a tall order, but I think this is a good time for us to look at it. And finally, quite important is the role of the banks themselves in employing outsourcing of people from outsourcing of work to the Philippines. For instance, JP Morgan reported there's 15,000 employees. The joke is JP Morgan is the BPO that has a bank in the Philippines, for instance. And maybe you can say the same thing about Hong Kong, Shanghai, and many other. Okay, so I think studies that focus on sectors that are more homogeneous and try to see what's happening to them over time and what's happening to the share in economic activity, rather than trying to apply econometric work to what's possibly a sector that's too heterogeneous, and you don't really know what's driving the rise or fall in wages and the rise and fall in labor productivity. But nonetheless, this is a very good first start. And I'd encourage the authors to keep doing this work and continuing to its logical conclusions. So congratulations to the authors for a good first start.
Thank you, Dr. Medalla, for your kind words and wisdom, sir. And now our next paper, entitled An Empirical Exploration of Financial Inclusion in the Philippines, will be presented by Dr. Margarita Debuque-Gonzales, a senior research fellow at the PIDS. Her research interests are in the areas of monetary economics, financial economics, macroeconomics, and development. Prior to joining PIDS, she was an associate professor at the University of the Philippines School of Economics, where she headed the Financial and International Economics Committee and the Union Bank Center for Financial and Monetary Economics. She has published in several economics and finance journals over the years. Her most recent research came out last April 2021 in Economic Systems, with the title Local Fiscal Multipliers and Spillover Effects, Evidence from Philippine Regions, and this October 2021 in the Philippine Review of Economics on Policy Responses to Shocks and Monetary Effectiveness under Inflation Targeting, the Philippine Case. She obtained her PhD in economics from UPSE. Her discussant will be Dr. Gilberto M. Llanto, who was formerly president of the PIDS. Currently, he is a member of PIDS Board of Trustees and co-chair of the editorial board of the Philippine Journal of Development, published by PIDS. He also served as the Deputy Director General of the National Economic and Development Authority, Vice President of PIDS, and Executive Director of the Agricultural Credit Policy Council. He was also formerly President of the Philippine Economic Society and member of the Governing Board of the Agricultural Guarantee Fund Pool. His research interests include local finance, public finance, infrastructure, regulatory impact assessment, regional integration, and growth economics. He obtained his PhD in economics from the School of Economics at the University of the Philippines. A few other relevant credentials to the subject matter at hand from Dr. Llanto is he's a member of the Technical Committee for Economics of the Commission of Higher Education, member of the Academic Steering Committee on Financial Inclusion of the International Cooperative and Mutual Insurance Federation, a referee, reviewer in technical journals, World Development, Philippine Review of Economics, Environmental Development and Sustainability, Journal of Southeast Asian Economies, Journal of Public Affairs and Development, Journal of Development Studies, and the Australian Journal of Asian Law. So, ma'am, sir, good morning, and we'll leave the floor to you.
Good morning. Good morning, everyone. So I'll jump straight into my PowerPoint. Okay. So hopefully you can see my screen. Okay. Can everybody see my screen? Can
Yes,
everybody
we
see?
can see. Yep.
Okay, thank you. Sorry, running blind here. Okay, good morning, everyone. Thank you to BSP for allowing us to share our research here at the Philippine Institute for Development Studies. The paper I will be presenting is a paper I co-wrote with John Paul Corpus, a supervising research specialist here at PIDS. And we have a different name now for our paper, and we called it Understanding and Measuring Financial Inclusion in the Philippines. Okay, so what is the motivation? Why did we study financial inclusion? Well, for its benefits, financial inclusion helps individuals as well as small businesses invest for the future. It helps smooth consumption. It helps households and small businesses to manage their finances. And therefore, it can help enhance productivity and long-term growth and potentially help reduce poverty and inequality. So this is what we see in the literature as we have cited in our slide. It's a timely topic because according to new research, financial inclusion can mitigate the detrimental effect of inequality on poverty. So in a new paper, Gutierrez, Romero, and Ahmed, they tried to forecast what will happen to poverty in COVID, and they saw extreme poverty will rise. But they also said, well, there is something you can do, and that something is financial inclusion. They believe that financial inclusion can also help substantially lessen the harsh effects of the pandemic. We also saw a research gap in the literature because despite the interest in the area, we know that financial inclusion is front and center. For instance, at the BSP, there is still room for us to do our studies because there's still quite limited research in terms of the relationship between inclusion and such things as growth and development and financial stability and even monetary policymaking, especially when you're talking about subnational, national and subnational levels, because most of the studies that are out there are mostly cross-country studies. So we have a 3-in-1, kape. We have 3-in-1 research paper. We have 3 research questions. Number 1, how does the Philippines compare with other countries in terms of developing, with other countries, in developing Asia in terms of financial inclusion? What are the stylized facts of financial inclusion in the Philippines? And number 3, how do we construct a measure of financial inclusion in the Philippines, given that it's hard to measure, it's a multidimensional concept. So how do we now go about doing it? So I'll go very quickly. Question number 1, how does the country fare in the context of developing Asia? We look at different databases globally. We have your global microscope, which was mentioned by Governor Diokno. I have known him from so many iterations. So Governor Diokno, so there's the Global Microscope from EIU 2020, IMF Financial Access Survey 2019, World Bank Global Findex 2017. So what do we find here is that, the Philippines leads the region in terms of enabling environment for financial inclusion. And we are particularly strong in terms of stability and integrity, products and outlets, even government and policy, and to a certain extent also consumer protection. But we are quite challenged in terms of infrastructure, referring to payments infrastructure and the perennial problem of internet connectivity, digital IDs, and credit information. But while we are very strong in these areas, the country has mixed performance in terms of financial outreach. So this is from the IMF Financial Access Survey. So when we look at geographic penetration, so it's the number of branches or units per 1,000 square kilometers, we are about middle of the pack there. But when we look at demographic penetration, we are a bit challenged in this area. comparing ourselves with other countries in the Southeast Asian region, for example. We also lag a bit in terms of ownership of financial accounts. So again, comparing ourselves with the other economies in the region, we are a bit challenged in terms of ownership in a basic account, debit card ownership, credit card ownership, but middle of the pack in terms of mobile money account ownership. Same pattern in usage of financial services. We are a bit challenged in terms of formal saving, formal credit, the remittances through financial institutions, online payments or purchases, but middle of the pack in terms of mobile phone transactions. Now, when we look at the reasons given by those who are financially excluded in the country, there are both voluntary and involuntary reasons. Voluntary reasons are reasons that are sort of the choice of the person. So they may choose not to be included for, this is what they want. Involuntary reason is more of like there's a barrier that is preventing them from being included. And so if you look at, again, at the other Asian economies, it's color green. So voluntary are color green. I color coded this. But when we look at the Philippines and the nearest one is Indonesia, many of the reasons given are involuntary in nature, such as saying that it's too expensive to own an account. It's I lack documents, I can't open an account, or the financial institution is too far away. So strong points and points that we need to work on. Number 2 question, what are the stylized facts of financial inclusion in the Philippines? So this is something we need to know. We need to understand the phenomenon if we want to make more headway in terms of policy. So what we did here is we analyzed the available microdata on the Philippines. This one is from, we used the one from the World Bank Findex 2017. So yeah, it's a bit dated, but we are expecting new data from them, next year. So for the meantime, I think this is a good enough database to use. So as in any research venture, you have to acknowledge everybody who came before you. So in this case, we have Demiurge Content Clapper from the World Bank. They highlighted that national development drives differences in account penetration across countries, while personal income level drives differences in account penetration across individuals within countries. So the importance of income is very clear in their study. The second important paper is by Allen et al., 2016. They examined what they call the foundations of financial inclusion, and so they basically looked at individual and country characteristics. And they noted that the efficacy of national policies to promote financial inclusion depended on individual characteristics within a country. We also looked at Fungakova and Wheel. This is a paper on China, but they underscored the concept of involuntary exclusion, which we liked, which they also got actually from the seminal work of Allen, where involuntary exclusion, the reasons given for not owning an account may be due to a market failure or maybe a barrier that is preventable and therefore can be addressed through suitable policy. So the last set of studies we looked at is, of course, our very own Dr. Llanto studies, which were published in the Philippine Review of Economics in 2015 and with Llanto and Resilion 2017 at PIDS. And they were similarly motivated, like we were, by the observed challenges to further expansion of outreach and usage in the Philippines, despite financial inclusion being top of the agenda. And they found significantly positive relationships between household and individual access and use of financial services and different socioeconomic characteristics, which I'm sure was very helpful in the construction of policy. Now, in terms of empirical method, I will not dwell on this, same as Dr. Laura, time constraints. So suffice it to say that we used a series of probit regressions, single probit, and joint probit whenever it was needed. Joint probit, for those who are interested in econometrics, is really like your Heckman two-step approach, except we can't use that here because our second step is also a binary. We have a dependent variable that's also binary. So it's also a qualitative regression. So we use joint probit as estimation in those cases. So we use probit estimation to estimate probability of owning an account. So we looked at 4 regressions, one for formal account, one for debit card, one for mobile money account, and another for credit card. And then joint probit for account use, because you have to own an account before you can use it. So we used our dependent variables were saving, formal credit, domestic remittances through a financial institution, the fintech element, mobile phone transactions, and online transactions. And then we also looked at alternative sources of borrowing. So dependent variables there are related borrowing, meaning borrowing from family or friends, borrowing from informal savings groups, and borrowing from all sources. And then finally, which is like the meat of the paper, we looked at the probability of the reasons that were cited. And we talked about them earlier. 4 are voluntary in nature, meaning they reflect voluntary exclusion, and the other 4 are involuntary. For all the regressions, we have the same set of independent variables pertaining to age, sex, education, employment, income, and geographic area. Now, the important thing I just like to note in the regressor is I colored orange. Those are your base categories. So that's again, for those who like econometrics, that's the dummy variable you drop, so you don't fall into a dummy trap. And so that becomes your benchmark when you are making your analysis. Okay, we will see that more clearly later. And again, we use the World Bank Global Findex, which we like because it has a fintech angle. Okay, so now we look at the regressions. Sorry, I cannot move. So this represents the results of the first 2 regressions on formal account and debit card. Okay, so the blue bars refer to formal accounts, and the green bars refer to debit card regressions. Okay, so formal account regression blue, debit card regression green. If it's hollow,
I think we may have some technical difficulties on the side of Dr. Ma'am? Okay, so we'll try to get her back online. But perhaps in the meantime, in the interest of the continuity of our momentum, if Dr. Llanto would already like to give a few words, just maybe for the portions we've already covered. Dr. Llanto?
Yeah, hello.
Yes, while we're waiting for our colleague, sir, if you already have a few words on what has been discussed, perhaps so we can hear from you a bit.
I have not only few words, many words.
Yes, please, sir, go ahead.
Okay. Good morning. This is very curious commentator, or the discussion comes in the middle of the presentation of the main speaker, who was cut off from her presentation. But anyway, this is what I'll do. I'll give some comments, and I frame this as what I found and did not find in this excellent paper, Understanding and Measuring Financial Inclusion. Error is mine. Understanding and Measuring Financial Inclusion. Gwen, yung second page nga, please. Okay. Mr. Santo Domingo, you're asking for few words. Here they are. Few words too. The paper has clear objectives, rigorous methodology, and a systematic exposition of findings and conclusion. The paper attained its objectives. The paper is confirmatory. The paper provides robust support to earlier findings. The paper is novel and substantive, and I have some suggestions. How is that for a few words? Anyway, let me read from my prepared text my comments on this excellent paper. I would like to thank first PIDS for asking me to comment on the paper written by Dr. Maggie and John Paul entitled Understanding and Measuring Financial Inclusion in the Philippines. I congratulate the authors on a well-written piece. The paper has clear objectives, rigorous methodology, and a systematic exposition of findings and conclusions. I have no quarrel with the methodology used by Maggie and John Paul, but I would have probably discussed with them earlier prior to the full drafting of the paper, probably a new methodology, structural equation modeling, which I found out used in a paper presented to the DTI Competitiveness Forum, where the author used SEM to model competitiveness. And I think that's a very appropriate methodology, and I would like to discuss this with the authors later. This is not the time nor the place to discuss this, but a few words on SEM. We know for a fact that most social concepts are complex and multifaceted, and using single measures will not adequately cover the full conceptual map, and so we need multiple indicators. Problem is, when you use multiple indicators, there's some random error in the measured construct. So the process separates the random error from the true measure of the variable. So maybe this can be also applied to financial inclusion. And I would suggest in the next iteration or next paper, probably the researchers might want to take a look at this methodology, structural equation modeling, which is another way of looking at this phenomenon in place of the usual PCA method. Now, yan, babalik na ba si ano? Hindi pa? Okay. The paper attained its objectives. It was able to, I quote, benchmark financial inclusion in the Philippines versus other countries in developing Asia, capture stylized facts about financial inclusion in the country based on demand-side data, and construct a regional financial inclusion index. And Maggie said earlier that she and her co-author found a research gap, and I think estimating a regional financial inclusion index sort of is a good attempt, first initial attempt to fill that gap that they found in the literature. And that will be very useful because, as you said, you can now do some estimation of the links between financial inclusion, growth, development, and financial stability. Now, the paper is confirmatory. This confirmatory, insofar as some of its findings confirm earlier empirical findings on financial inclusion in both local and international literature. And I think Dr. Gonzales adverted to this because he mentioned an article published in the Philippine Review of Economics using microdata from the annual poverty indicators survey. So that paper estimated the factors affecting household decisions to participate in formal financial markets and the impact of utilization of financial services on household income. Vulnerable groups find it most difficult to access banking services, and that's part of the findings. However, utilizing a richer data set, Gonzales and Corpus' efforts yielded more insightful empirical results on the determinants of account ownership and account usage. Their findings on borrowing, however, mirror earlier results of researches on rural finance and agricultural credit done at the Agricultural Credit Policy Council. Perhaps the authors might want to advert to the rich literature on ag credit and rural finance to make their literature review more comprehensive and informing. Gonzales and Corpus, using global Findex data, the Philippine Review of Economics article earlier mentioned using data from the annual poverty indicators survey, in a recent PIDS paper using data from the BSP Financial Inclusion Survey point to education and income as significant determinants of account ownership and usage. Geography remains a critical determinant of account ownership, usage, and even fintech use. This fact lends robustness to the author's findings. So what we see here is that using different data sets, it seems to me that the various estimations arrive at the same or similar conclusions. The paper is novel and substantive. It always pays to find out how the country stands relative to other similarly situated countries based on some metric, this time financial inclusion, and check what drives financial inclusion. More importantly, the paper has contributed to the literature by constructing a novel regional financial inclusion index that will be very useful indeed in determining links between financial inclusion, growth, development, or financial stability, as the authors put it. Apart from their academic value, the findings have interesting policy implications. And the last three comments would veer towards that point of abiding policy implications. The authors, in their concluding remarks, noted that, and I quote, "The key finding of the paper pertains to the possible involuntary exclusion of the lower income and less educated segments of society because of barriers and possible market failures." Close quote. It would have educated the reader to explain what those possible market failures are and the barriers that drive involuntary exclusion, rather than leave the reader speculating on the possible constraining factors. Could those be market-driven factors, regulatory factors, or infrastructure limitations? Are those barriers supply side or demand side, or both? The way to answer this is to refer to contemporaneous literature that seems to shed light on this particular issue, asking about whether the constraining factors are market-driven, are they regulatory in character, or are they arising from infrastructure limitations? Well, I would like to draw the author's attention to an ADB volume, Financial Inclusion, Regulation, and Education, Asian Perspectives, published in 2017, which analyzes extensively various factors constraining financial inclusion and the challenges facing its country represented in the volume. For example, the chapter on the Philippines in that volume points to the government's primary role of creating broader and more interconnected ecosystems for the safe and efficient delivery of financial products to the poor. The authors could possibly connect their key findings and their other findings to what this ADB volume tries to explain. On the other hand, the authors mentioned in the concluding remarks also that such inclusive policies are already being pursued by the country's monetary and financial regulatory authorities, the BSP, and the national government. I thought that we had to tease out something more from that statement. The above-mentioned ADB publication speaks volumes about the BSP's effort at financial education and regulation to foster financial inclusion. The Philippine chapter is a good reference. It is noted that the BSP has issued more than 60 circulars on fostering financial inclusion. I thank Mr. Brian Mojica of BSP for this information. But are banks responsive to the BSP's regulatory stance on financial inclusion? So you can refer to contemporaneous literature describing the policy responses, regulatory responses of the BSP. And also there is data about how banks, most specifically the leading MFI banks, have responded to this BSP circulars and financial inclusion. There is data on how rural banks have responded to financial inclusion objectives, especially the leading MFI banks, for example, Card Bank. Finally, some attention should be given to internet connectivity in the paper's discussion of digital technologies and fintech as possible critical determinants of account ownership and account usage. I understand internet connectivity and related information are not included in the data set. What a researcher can do is to call attention to this gap in the data set and tell us that this is very important, and an estimation of financial inclusion wouldn't be complete without adverting to or using data on the internet connectivity. It is a pity that the data set used for estimation does not include internet data such as speed and quality, telco infrastructure, mobile and fixed broadband services offered in different parts of the country, and other data. The authors might want to highlight internet connectivity as a necessary condition for financial inclusion in the digital economy. I end here. Thank you very much for giving me this opportunity.
And we are happy to welcome back Dr. Maggie. Dr. Maggie, we can give you 8 minutes, ma'am, to for you to either continue with your presentation. Please, we are eager to see the rest of it, or respond to Dr. Llanto, or a combination of both. So, would you like to share your slides, ma'am, again, and continue? Now. All right, so while we are trying to share the screen, may I just already take this chance to make an announcement about our Q&A and chat box, which will happen later on. So we have two options for you to raise your questions, either in the chat box or the Q&A function of Zoom. For those of you joining us from a Facebook feed, please feel free to send your questions through the chat function of Facebook, and we will try to bring those questions to attention. But there you are, Doc Maggie. Yes, we can see your slides now, ma'am. We have about five to 6 minutes, ma'am. If you'd like to continue, please. Thank you.
Hi, Sir Jed. I think Miss Maggie is on mute.
All right. I think unfortunately we may have lost Miss Maggie again. She's no longer online, correct? All right. So, well, let's see if perhaps towards the open forum we'll have some.
Hello. Can you hear me? Can you hear me?
Yes, Miss Maggie.
Miss
Maggie, we can give you a few more minutes,
I'm really
ma'am.
sorry. Now how many? 4 minutes na lang.
Yeah. Okay.
So the point is,
5 minutes, ma'am. Go ahead. Thank you.
Okay, so point well taken on the internet connectivity. So clearly, that is where the biggest, my difficult, I live in
I think we're really having trouble hearing you, ma'am. Hello. Okay. I think unfortunately we may need to reconvene later. Perhaps we can just go forward with our next.
Connectivity here. So yeah. So I will
ready to move on to our next presentation. Perhaps we'll see in the open forum if we can give a minute or two to Doc Maggie. Our next presenter is Dr. Hazel Parcon-Santos, who will present the paper entitled ASEAN 5 Countries in Competition for FDI. She is currently a senior researcher at the BSP Research Academy. Dr. Parcon-Santos has been with the BSP for 10 years now. Prior to joining the Academy, she was part of the Center for Monetary and Financial Policy of the BSP and was detailed as a visiting research economist at the Bank for International Settlements Asian office in Hong Kong in 2018. Prior to joining the BSP, she had a one-year stint as an associate professor at the De La Salle University. She was also a researcher and lecturer at the University of Hawaii in Manoa, where she obtained her PhD in economics. Her research interests include economics of international capital flows, foreign direct investments, and macro financial linkages. Our discussant will be Dr. Myrna, Austria, a university fellow and full professor at the School of Economics, De La Salle University. Her areas of specialization include trade investment and industrial policy, development economics, competition policy, and regional economic integration. She has published journal articles, monographs, chapters in books, and policy briefs along these areas. She earned both her master's degree and Doctor of Philosophy in Economics at the Australian National University. She has served De La Salle University in various capacities: Vice Chancellor for Academics, Dean of the College of Business and Economics, and Director for the Center for Business and Economics Research and Development. She has assessed several top universities in ASEAN as Chief and Lead Quality Assurance Assessor under the ASEAN University Network. Her career spans positions at the PIDS, the Philippine Apex Study Center Network Secretariat, the National Economic and Development Authority, including consultancy work for various international organizations such as the Asian Development Bank and the U.S. Agency for International Development. Really, the list goes on. So we are very grateful also to have Dr. Austria with us. With that, Dr. Parcon-Santos, or Hazel, as we know her in the BSP, please take the floor. Thank you. Hazel?
Hi, Jet. Good
Yes,
morning.
there you go.
Thank you for your kind introduction. Can you see my slides?
Yes, we can see your slide now.
Okay. So a good day to everyone tuned in today's BSP-PIDS Research Forum. So I'm sharing my screen now. The paper that I am presenting is entitled ASEAN 5 in Competition for FDI. My co-authors in this paper are two Marias or two Maries, Maria Rica Amador and Mary Edelweiss Romarate, also from the Bangko Sentral ng Pilipinas. Well, at the outset, I want to say that we are really not introducing anything spectacularly new in this paper, but my co-authors and I believe that our paper is like a classic story that never seems to grow old, and it seems that it has enduring relevance and ideas that are always worthy to revisit. And we think that it has some important implications that could serve as a reminder to policymakers and to the general public as well. Now, as an early clarification, the ASEAN 5 that we are referring to in our studies include Malaysia, Indonesia, the Philippines, Thailand, and Vietnam. The IMF also refers to these 5 economies as ASEAN 5 in their World Economic Outlook reports. Now, my presentation is outlined as follows. I will spend some time in presenting the stylized facts because that somehow motivates our research questions. So in 2020, we all know that COVID-19 pandemic created a lot of economic uncertainties that delayed investment plans. As a consequence, FDI flows plunged globally by 35%. And according to UNCTAD, this is the biggest decline since 2009. And the Southeast Asian region saw a 25% decline in incoming FDI. Now, FDI is deemed to be an important source of financing post-pandemic or in the recovery phase as it can help generate more jobs. While global FDI is expected to partially recover in 2021, this year, it is expected to remain below pre-crisis levels. Now, the lower levels of FDI is expected to increase the competition among economies, as emphasized by the UNESCAP. Of course, even before the COVID-19 pandemic, countries were already in competition to attract FDI, but the pandemic further intensified the competition. So governments need to pay closer attention on how to improve their investment environments to retain and attract FDI. Now, some countries have implemented measures to incorporate FDI-related policies in their COVID-19 recovery plans. For the case of the Philippines, CREATE, or the Corporate Recovery and Tax Incentives for Enterprises Act, was passed on the first half of 2021, which reduces corporate income tax rates in foreign corporations from 30% to 25%. Authorities have also been pushing to further open the economy to foreign investors by lifting restrictions in certain sectors. So, for instance, in retail, trade, and public services. Now, amidst efforts to attract FDI, some economies are facing deterioration in their macroeconomic outlook as a result of potential scarring effects of the pandemic. So, for instance, some credit rating agencies have flagged downward pressures in the economies of Indonesia, Malaysia, and the Philippines. And this may make it even more challenging for countries to attract and retain FDI. This may be relevant because, as I shall show later, sovereign credit ratings may play a role in attracting FDI. Now, before we proceed any further, it is useful to take a look at how the FDI performance of the ASEAN region progressed throughout the decades. From the 1980s to the most recent decade, ASEAN FDI inward inflows and stock relative to the region's GDP and relative to the world inward FDI flows and stock have continuously increased. This reflects the increasing attractiveness of the region as a destination for FDI, which may be attributed to member countries' improving macroeconomic fundamentals and policy environment. It can also be noted that regulatory restrictions on FDI have decreased throughout the years. So these improvements and developments were attested by several upgrades received by some ASEAN countries from sovereign credit rating agencies. And these upgrades were largely on account of improving macroeconomic stability and strengthening policy frameworks and institutions. Of course, sovereign credit ratings relate to debt and creditworthiness of the central government, but they may also serve as a barometer of confidence in the economy that may be used as a source of information by private direct investors. So, for instance, in 2011 to 2015, the Philippines received several rating upgrades from the three major sovereign credit rating agencies, and in 2013, we became investment grade. And in those years and in subsequent years, the FDI performance of the Philippines notably improved. Nonetheless, it is worthwhile to also examine our performance relative to our ASEAN peers. Also, while the ASEAN FDI picture appears propitious on average, individual country experiences have been varied, as seen in this figure 5. Now, Singapore has been the consistent top recipient country of FDI in the region throughout the decades, but the experience of other countries in the region has been mixed. For instance, the Philippines, Malaysia, and Thailand slipped in terms of their FDI shares in the region from the 1980s to the recent decade. And the Philippines, in particular, saw its share decline from about 8% in the 1980s to just 3% in the 2010s. Meanwhile, we see Indonesia and Vietnam improving their FDI performance throughout the decades. So figure 5 is very telling, and it highlights that within ASEAN, countries could be or are competing for FDI. Now, this pie chart shows the source countries of FDI inflows into the ASEAN in the most recent decade. In the top 15 are non-Asian and 6 non-Asian countries, while the bar charts here show the destination economies of FDI from the top 5 source countries. And as of end 2019, Japan, the USA, China, and Hong Kong all have invested most in Thailand, while Singapore has invested most in Indonesia. Notable is that while China has increased its FDI in all ASEAN 5 countries, it has invested the least in the Philippines. Meanwhile, the top recipient sector in the recent decade is the financial and insurance activities, followed by manufacturing sector. In this slide, we see that 13 out of the top 15 source countries have manufacturing in their top 5 recipient sectors. And while we see that financial services is the top destination sector by 8 out of the top 15 source countries. So, given the foregoing developments, our study asks, what factors explain differences in FDI across ASEAN 5 countries? And how do foreign investors differentiate across host countries? In addition, given the potential relevance of sovereign credit ratings in attracting FDI, our study also asks, are sovereign credit ratings useful in determining an economy's attractiveness for FDI? So what does the literature tell us? The theoretical and empirical literature on the determinants of FDI is very rich, reflecting not just the great interest in the subject, but the importance of FDI as a source of capital and the potential of foreign investors to influence domestic economic activities and outcomes. So a standard and influential framework that has been used in the investigation of determinants of FDI is the OLI, or Ownership, Location, and Internationalization Framework of Dunning. Both O and I, or Ownership and Internationalization, depend on the firm, while L, or Locational Advantage, depends on the host country. When several countries are being considered by a multinational enterprise to host its FDI, it will choose based on the locational advantage offered by the host. So locational factors help explain why host countries try to continue to upgrade their competitive advantage. Now, the relative significance of the different locational factors is related to the type of FDI. So for instance, market-seeking or horizontal FDI is expected to give more weight to market size or potential demand in a host country, while efficiency-seeking or vertical FDI may give more importance to cost factors such as labor and cross-border transportation costs. Meanwhile, the third country export platform FDI, or sometimes referred to as mixed motives or complex FDI, where the output of the FDI host country is exported to third countries rather than back to the FDI source country, is expected to give attention to both cost factors and market size, not just of the host country, but of the region where the host country is located. Now, the empirical literature on these locational factors is vast. Studies emphasize that FDI constitutes long-term investments. Thus, it would be most attracted with the long-term considerations about the economy, such as macroeconomic stability, market size, economic openness, and labor cost considerations. Now, over time, there has been changes or shift in the relevance assigned by foreign investors on different locational factors. So based on studies, tax-related variables, infrastructure, and institutions have become prominent factors. And emerging studies have also shown that the information provided by sovereign credit agencies can spill over to FDI. Now, we undertake a simple empirical investigation on some of the possible determinants of FDI to the ASEAN 5 countries from the top 15 ASEAN FDI source countries using a gravity model approach. So the FDI from the top 15 source countries comprise 73% of the total ASEAN FDI. And the 15 source countries and 5 host countries give a total of 75 unique country pairs, but in our estimations, we use 70 country pairs. Now, in its basic formulation, the gravity model applied to FDI states that FDI in a host country is positively related to the product of the economic or market sizes of the source and host countries and negatively related to the distance between them. As a convention also, factors that impose investment costs on the source country is added to D. Okay. Now, our dependent variable is the outward FDI position from source country I to host country J, which we obtained from the Coordinated Direct Investment Survey of the International Monetary Fund. In line with the recent empirical literature, we employ a Poisson pseudo-maximum likelihood estimator to estimate our gravity model. And then Santos, Silva, and Teniero and other authors demonstrated that this estimator is superior in estimating the gravity equation in comparison to other estimators. And we use annual data for the period 2009 to 2019 since we are constrained by the availability of bilateral FDI data from the CDIS. Before we take a look at the results of our estimations, let's take a look at which countries have the highest or lowest values for the different locational factors that we included in our estimations. So these rankings were based on values as of end 2019. Thailand has the highest inward FDI stock from the 15 source countries, while the Philippines has the lowest. Indonesia has the largest market size. Malaysia, meanwhile, has the highest sovereign credit ratings, highest corruption perception index, which means that it is perceived to be the least corrupt among the ASEAN 5. It has the highest rule of law index, ease of doing business score, road quality, and telecommunications infrastructure index. It also has the highest minimum wage. Thailand, meanwhile, has the highest human capital index and the lowest corporate tax rates, along with Vietnam. And Vietnam has the lowest minimum wage and FDI restrictiveness, equity restrictiveness index. The Philippines, meanwhile, has the highest corporate tax rate and FDI equity restrictiveness index, and the lowest corruption perception index, which means that it is perceived to be the most corrupt among the ASEAN 5. The Philippines also has the lowest rule of law index, lowest ease of doing business score, and lowest road quality index. So now let's take a look at the results using FDI for the whole sample, that is FDI from the top 15 source countries to the ASEAN 5. We included first the traditional gravity variables and the sovereign credit ratings in our regressions. In this first set of regression, results show that foreign investors are attracted to countries with large market sizes but are generally deterred by greater distance. Sovereign credit ratings are all positively and significantly associated with FDI, which implies that higher sovereign credit ratings can prompt foreign investors to increase their FDI position in the host country. Next, we remove the sovereign credit ratings since sovereign credit ratings have high correlation with other locational factors such as inflation, which is our proxy for macroeconomic stability. We included also governance indicators, ease of doing business, and quality of infrastructure. We also included in these estimations minimum wage, corporate taxes, quality of human capital, and FDI equity restrictions. Our results show that we find strong evidence that high corporate tax rates deter foreign investors. There's also some evidence that foreign equity restrictions have a negative and significant impact on investment or FDI. We also found some evidence that foreigners invest more in countries with good quality of human capital, less corruption, better rule of law, and higher quality of infrastructure. Foreign investors are also attracted to invest in countries with greater ease of trading across borders. Meanwhile, we find marginal impact for minimum wage and inflation. Next, we divided our sample, our source countries, into Asian and non-Asian countries, and we ran both sets of the same regressions using these two different samples. So we ran our regressions for the Asian source countries, but in the non-Asian. But in the interest of time, let me skip these tables and proceed to our summary table. So our estimations reveal some differences between Asian and non-Asian foreign investors. We found that small market size of the source country appears to be a motivation for some Asian economies to invest in ASEAN 5 countries. Sovereign credit ratings also appear to have a positive signaling effect on non-Asian investors, but not for Asian investors. Our estimations also suggest that non-Asian investors are more sensitive to labor costs and governance. The latter suggests that Asian investors are better able to deal with corruption or government bureaucracy, probably because they may be familiar with the culture already. Nonetheless, we also see or find common findings regardless of the FDI source country. For instance, foreign direct investors tend to invest more in host countries with larger market sizes. Also, foreign direct investors, regardless of where they come from, are deterred by high corporate taxes. Ease of trading across borders is also an important factor considered by foreign direct investors in ASEAN 5, which could be due in part to the ASEAN 5 countries' participation in the Asian production network. Then, of course, foreign equity restrictions deter FDI regardless of where direct investors are from. So this slide just summarizes what I just mentioned earlier. We did a number of robustness checks, and most are supportive of our findings, of these findings. And we also conducted a RANSI regression specification error test for all our estimations, and our results indicate that all the estimations or specifications are correctly specified. Of course, our results are limited by the fact that aggregated FDI is used in the estimations instead of by type or by sector. Hence, the estimates of the impact of the different factors on the decision to invest only reflects average effects. In addition, the locational factors that we considered in this study may not be exhaustive. So to conclude, we found that first, sovereign credit ratings have signaling effects for foreign direct investors, which bodes well for governments that are pushing measures to improve credit ratings. Of course, with the end goal of enhancing an economy's efficiency and competitiveness. This also implies that increased attention given to a country because of its assessments from credit rating agencies can spill over to FDI. So governments will be actually hitting two birds with one stone. The government will be able to borrow at lower interest rates and at the same time attract more foreign direct investments. Second, while lowering corporate tax rates can potentially increase FDI, countries also need to be wary that this should not result in a race to the bottom, as this may end up being counterproductive, as it can have significant repercussions on spending on essential public services, including infrastructure. Third, reducing restrictions on foreign equity can have a significant impact on investment. So this underscores the need to regularly assess regulations on FDI, as restrictions can have significant opportunity costs associated with foregone investments. Fourth, the ease of trading across borders is important for foreign investors in ASEAN 5, suggesting that export platform FDI is particularly important for the region. This is expected as the ASEAN 5 countries are part of the Asian production network. Fifth, while public governance appears to be important only for some investors based on our estimates, it must be recognized that it is positively and highly correlated with ease of doing business and quality of infrastructure. Finally, our study highlights that there's no factor that can single-handedly attract FDI. Foreign investors are attracted by a range of economic and non-economic factors. So for policy, this suggests that a holistic approach is needed to successfully retain and attract FDI. So this ends my presentation. Thank you very much for your kind attention.
Thank you so much, Hazel. Now we call on Dr. Myrna, Austria, ma'am, for your reactions, please.
Can I share my screen?
Of course.
Hi, Hazel.
Hi, ma'am.
I'm still seeing yours.
Ay, wait.
How do I stop share?
There you go. Okay. Okay, good morning, everyone. First of all, I'd like to thank PIDS and BSP for inviting me to participate in this very important forum as we discussed how countries, Philippines, for example, would prepare for our economic recovery. Um, at the outset, I'd like to say that I enjoyed reading the paper. Congratulations, Hazel, and to her team. It's an easy and interesting read, actually. But of course, I have some comments and hoping that those comments would improve the paper. So the paper highlighted the importance of foreign direct investment for the post-pandemic economic recovery of the ASEAN countries, no? Especially the ASEAN 5. Now, given the huge government expenditures that these countries have had, no, in response to the pandemic, to mitigate the adverse impact of the pandemic, then these countries have very limited fiscal resources or budget to bring back their economic growth. No? And so, given that as a background, I would say that this paper asked the right questions. Okay, the three questions that Hazel has outlined a few minutes ago are really very, very relevant and important at this point in time. So let me just have a quick summary of what the paper is all about, what it has done, and all that. No, I have no issues as far as the methodology used was concerned. It applied the standard gravity model and used the PPML as an its estimator. The 5 ASEAN countries are covered. I think it has enough data points to make the estimation strong, about 70 or 75, covering 10 years. No? But what I like the fact is that the gravity model was also expanded to include locational and institutional quality factors that are now becoming more important as determinants of FDI. Also, as outlined by Hazel, no, 3 sets of estimation using the same model, 3 sets of estimations were done according to source countries. So we have the whole sample, including all the 15 countries, and I tried to distinguish the effects or the determinants of FDI if we kind of segregate or differentiate, no, the top Asian source countries from the non-Asian countries. Also, with the same model, they had several specifications by including or excluding certain variables to test their significance in determining FDI. And I'm glad they did that because given the several variables that they have included, and most of them are in index form, we expect that there will be a lot of correlation among the variables. So it was a good approach to either include or exclude certain variables just to test the significance of those variables. Now let me go to my impressions on the general findings. No? One of the sections of the paper that I enjoyed reading the most was the stylus facts. I find it very informative and it provides up-to-date and comparative data on the ASEAN 5 on FDI stocks and the variables that are considered in the empirical model. I think that was a good approach to provide the rationale in terms of the questions that were asked by the paper. Also, the results of the study are consistent with the literature and empirical work that have been done. Across the 3 sets of estimation, common factors that are found statistically significant affecting FDI would include host market size, distance, corporate tax rate, foreign equity restrictions, governance indicators, or ease of doing business. I put here "or" because in the estimation, the governance indicators would be insignificant once the ease of doing business is incorporated because the variables that are included in the indices are also correlated. But what I find more telling, no, is that across the 3 sets of estimation, minimum wage, inflation, and human capital index lost their significance once governance indicators or ease of doing business or infrastructure quality are included in the specification. to me, this is very telling, no? Especially on the findings about the minimum wage. With my own experience with dealing with industries in the Philippines in particular, no? I know that this finding would apply to the ASEAN 5, but if you look at it from the context of the Philippines, I find this finding on the insignificance of minimum wage very, very telling, because as I've said, based on my dealings with industries in the country, they would often argue that the high minimum wage in the country is what makes the country less attractive for foreign direct investment. In fact, they would even use it as an argument against increasing the minimum wage. They would often say that would scare, increasing further the minimum wage would scare the foreign investors. No? And so, given this finding here, to me, as I've said, it's very telling, that kind of perception from among our industries, although it could be specific, no? That kind of impression could be specific to certain industries like garments and textile, for example, or even electronics, the industries that I've been looking at in my own research work. That kind of wrong perception, it has to be corrected. No? And if, as I've said, no, it looks like governance indicators or ease of doing business are becoming more important consideration by source countries of FDI rather than minimum wage and inflation. Although in the paper, Hazel and her team try to qualify that once the country has achieved a particular macroeconomic stability, then these factors become insignificant. Okay, so of course that was qualified, but as I said, it's an information that has to be disseminated, especially when every time we ask for an increase in the minimum wage. No? Now, in terms of my comments, no? I was expecting you, Hazel, to show 6.2 and 7.2, but you just said in the interest of time, and you just went to the summary. No? But when I was comparing table 6.2 and 7.2, no? I find that foreign equity restrictions, no, are negative and significant for all specifications for the top Asian source countries, and that's what we expected. That's why Philippines, for example, have been trying to pass bills, no, and laws to lower, no, the foreign equity restrictions in the country so that we could attract more foreign investment coming into the country. But for non-Asian countries, no, the foreign equity restriction is positive, and in fact, it's significant for most of the specifications, 8 out of 10 of the specifications. Initially, I thought it was typo error. No? So I was expecting you really to show that table. But I keep on looking at it, and it's really positive and it's significant. And this particular finding, to me, runs counter to our expectations. So, and unfortunately, that wasn't explained in the paper. So probably that would need you owe us an explanation why that the finding is as such, no, unless I said it's typo error. No? So what could possibly explain that? No? Do really top non-Asian countries, they really don't consider foreign equity restrictions, or it could also vary across industries, which unfortunately you did do that kind of methodology, right? So I don't know. No, so that's one of my comments. No? The other one is this one is not really. I'm not against it. No, but I'm trying to expand the discussion, particularly in the context of the Philippines, because in the paper there was really no policy implications. No, in the discussion, what are the implications of this one to Philippines or to any of the ASEAN 5? But consistently in all the 3 sets of estimation, you find corporate income tax to be a deterrent to FDI. And in fact, that has been always the reason why we have been asking the government to lower our corporate tax rate, no? Corporate income tax rate. But if you look at our tax rate, it's still, even if we have lowered it from 30% to 25%, no? The Philippines is still has the highest rate among the ASEAN 5. In fact, it's the highest among the ASEAN as a region. In fact, we're just as the same as Myanmar, I think, with the new rate 25. The rest are below 25. No, But given the country's limited fiscal space, will there be room for further decrease? No? What would be the marginal effect if the Philippines would lower it further? No? I'm not talking here, when I say marginal effect, I'm not talking here about the numerical elasticity that you have had in the paper, but I'm talking here more in general terms. Like if we lower it further, the corporate income tax rate, because so that we could attract more FDI, and considering that our tax rate is much higher, still even with the create law, no. I'm talking about you have the margin. If we lower it further, will it make would it contribute more to our long-term economic growth? That's what I meant by the marginal effect rather than the elasticity. And my reason being are the following. No? If we will have a choice, at least to me personally, if there's a choice between corporate income tax and governance indicators, no? Or ease of doing business, I'd rather that we prioritize improving our governance indicators or enhancing our ease of doing business. And why am I telling that? No? If you look at the debt to GDP ratio in the Philippines, we have a bigger window prior to the pandemic. The previous administration had succeeded in lowering the debt to GDP ratio. In fact, by 2019, it was only 39.6. And that's why when we had the pandemic, there's a lot of window to borrow, no? To have more foreign loans. No? But considering what we have now in 2020, it's 53.5%. No? So I don't see wisdom by borrowing more. So I thought that if it's question about is it corporate income tax or governance indicators, I'd rather that, again, to prioritize, no? Giving in terms of policies, no, and programs for the government to prioritize governance indicators, because this would have a more lasting positive implications on our long-run growth rate, especially that if they are meant for that long-term investment, rather than lowering further our income tax rate and losing some of the revenue. And that would be increasing the debt to GDP ratio further would be a more deterrent to long-term growth rate of the economy. So to me personally, I think this should be expounded, this kind of issues should be expounded when you would like to share these results to our own policymakers, because they might, corporations, they might argue further of lowering the income tax rate, no? And I've said that would limit us our minimum fiscal space already. Okay, that's one. The other one is, and it's the last one here, and I'd like to spend some time. No? It's about this factor wasn't considered in the model. In fact, even in the stylus facts, no? But I thought that it's a very important factor that should be considered, because it's emerging in a lot of discussion on FDI. The new issues about factors affecting FDI. And I'm talking here about the Industry 4.0. Okay, the restructuring of international production due to industrial automation and digitalization of the supply chain could affect the attractiveness of the ASEAN 5. And in fact, the whole of the ASEAN as FDI host. No? Let me give you some background on, and Hazel, remember we did a lot of work on this one when you were still with DLSU. No? It's highly documented, well documented in the literature, that since the 1990s, FDI in ASEAN 5 has been largely driven by the global production network of multinational enterprises from US, Japan, and Europe. No? In fact, these are the kind of FDIs that are efficiency-seeking and export platform type of FDI. They would like to take advantage of the lower production cost, particularly labor cost in the country. You know? And that's why we see a lot of offshoring of the multinational enterprises in terms of their operation in the ASEAN 5, okay, including Singapore, and of course, even in the East Asia as a whole. No? But recent advances in technology, no? And especially 2010 onwards, or it's starting 2000, have changed a lot in terms of the way goods and services are produced. And I would like to emphasize services because that was the first paper as well, no? By Laura, I think, on ICT and all that. No? But the digitalization, I'm not just this, I'm referring about the operations and how services that are needed by one particular firm, for example, are all digitized. No? And the advent of industrial robots, for example, or AI-enabled systems, have the potential to reverse this trend. No? Meaning, it may trigger, and in fact, it's what we're seeing now. A lot of if you look at the World Investment Report in 2020, they have documented that AI or this automation thing, the digitalization is now widely used in automotive and electronics industry. Two industries that the ASEAN and East Asia are well known for in terms of their FDI. No? But because the ASEAN and a lot of developing countries are struggling with their technology, improving their technology to respond to the needs of the MNEs, given AI and digitalization. There's an issue about that being reversed. I mean, reshoring could be now the trend rather than offshoring. So in that sense, the ASEAN might lose their comparative advantage in the low-cost manufacturing hubs that we now have. Now, as I've said, the World Investment Report highlighted automotive and electronics industry, where the same industries that GPNs or Global Production Network are very popular in the region, and in fact, they're the ones that really propelled our economic growth. So, having said that, even with the pandemic, as discussed a while back by the governor, the Dr. Diokno, in terms of I was listening to his opening remarks. The pandemic has caused a lot of disruptions. In fact, the supply chain in the region was heavily affected because of the travel restrictions. Then goods and services could not just flow easily across the region. And what happens in the pandemic would have a long-term policy implications in terms of the plans of the MNEs. In fact, it's also now being discussed in UNCTAD. It's not just about health issue. It's not just about recovering from making us healthy, making all the workers healthy. But what are the implications of what happened during the pandemic? What happens in terms of the supply chain? How would multinational companies react and change their strategic directions? Because there was kind of fear, that the cut in the supply chain, of course, that lowered FDI in the region. So, given their strategy to be more resilient, to be more sustainable in terms across their global supply chain, then as I've said, that could trigger a reversal trend, and we are seeing a lot of instead of offshoring, we're seeing a lot of nearshoring, yung pabalik, instead na lumabas ng mga host countries, pabalik sa kanila. And again, the two factors here, it's not just about the pandemic, but we're struggling, as I've said, in terms of our technological level. So unless our technological level in the region would meet the needs of digitalization, the automation, and all that, then you might be losing what used to be our competitive advantage as far as attracting FDI in the region. So my suggestion, in fact, just finally, to as you said, it's still preliminary and all that, is probably there's a need to expand model to include an indicator, an index on technological innovation in production. I emphasize here innovation in production because in one of your variables, ICT infrastructure, I'm not referring to that kind of innovation and infrastructure. I'm referring here more on the production itself. Now, how much of our production, or particularly our exports, are technology intensive? So I'm not sure whether there's an index that could be used in the model, or you might want to look at the UNCTAD database where they classify exports in terms of the level of technology. They would classify as low technology intensive, medium technology intensive, or high technology intensive. And probably if you could use this, I'm not sure if this is the one, but there could be an index or it could be an indicator. But my point here is there should be some indicator of the level of technological innovations, okay, there's not much documentation yet because here we are moving forward, right? And then and your data and your regression is mostly using past data, right? But given the changing strategic directions of MNEs, multinational enterprises, as a result of digitalization, Industry 4.0, we really cannot predict what is ahead. And but the literature, UNCTAD, the investment report by the World Bank is highly emphasizing about the importance of leveling up the technology of developing countries, because so that they could get more of the value capture, because now MNEs and the host countries are more concerned about control of their supply chain. When I say control, that they don't want to be uncertain because of the supply chain breakdown. They don't have a control of that. All the MNEs are operating their headquarters in the developed countries, but all their operations are here in the Asian countries, which are heavily affected by the pandemic. So now I think the emerging discussion is that the realization of what the pandemic did to the supply chain is giving them some rethinking of their strategic directions moving forward post-pandemic. But then again, I'd like to end that really what you now have is really good, and I must admit I would understand if you don't have a specific policy recommendations for the Philippines, but I would because the paper is about ASEAN 5, right? But I would suggest if you could have a short policy brief, if only for the policy implications on the Philippines, so that it would be helpful, for the country and for the next administration as they plan out for our post-pandemic economic recovery. Thank you very much. I'll end my presentation there.
Hazel and Dr. Austria. We now give a few minutes, again, 2 or 3 minutes to Dr. Margarita Debuque-Gonzales. Maybe just give us a summary or a synthesis, ma'am, of what we may have missed. We're eager to see the rest of your presentation.
Okay, can you hear me now?
Yes.
I'll turn off my video, so just to help things along.
Yes,
So I'll
yes,
go
thank
straight
you.
to the takeaways. So you're spared the econometrics, so you just get the results. Financial inclusion, we found, is more likely if one is richer, more educated, wage employed, female or older, up to retirement and middle age respectively. Now the thing, well, it may not be really new results, but I'd like to think we did it in a way that allowed us to get little details, like when does the financial inclusion taper, and so we were able to compute the ages when they happen, and we found that for basic accounts, it usually tapers around retirement age, and we're talking about formal credit, it tapers around the age of 50. Okay, so it's quite useful, I think, information for the private sector and the public sector. One other takeaway from our regressions was that fintech in the form of mobile money seems most promising, with seemingly the most equitable access among the different forms of financial inclusion. Now, I say most promising because this data, remember, was 2017, and so we had a small sample there, and I'm guessing that by now this would be already totally a solid result by now. Okay, especially during and after the pandemic. In analyzing the barriers to financial account ownership, we found that involuntary exclusion of some underserved sectors were apparent. And this means that the reasons why they don't have an account refer to things like cost, banking cost, distance of the bank, those kinds of reasons, which can be adjusted by policy. Formal credit remains underdeveloped. That is a very clear result in our paper. But empirical results suggest that improvement in education, aside from income and employment, could allow better access to formal borrowing sources. Now, this is actually the meat of the paper. It's really coming up with an index, because that is the key that will unlock other research areas. Okay, so I think a lot of our great predecessors already done a lot in terms of trying to understand the phenomenon. But if we get that measure, we're able to unlock things like how does financial inclusion affect growth in the Philippines? How does it affect poverty? How does it affect inequality? How does it affect financial stability, most importantly, more importantly, well, equally importantly, and how does it affect monetary policy? So this is just a literature review. I'd just like to highlight that no, we did not enter in this field and just, we do acknowledge a lot of people who came before us, but especially I'd like to acknowledge the young BSP researchers who have done most of the work here. If you look at Philippine studies, one of the main studies there is by Minard Mojica, who was very kind enough to help us with the data. He's with CLIA at BSP, and our own national statistician, Dennis Mapa. So they were able to construct an index, came out in Philippine Statistician 2017. And I think Tan, I think her name is Tatum Tan, is also from BSP 2014. So they both used non-parametric methods and created cross-section indicators for Philippine provinces and regions, respectively. And Rosvern Reyes, also from BSP, who generated a regional index using different techniques and was able to create panel data for the years 2005 to 2016. Now, I know about Rosvern's paper because I was the reader for his master's thesis, so commercial lang. The challenge is fine. I'll spare you the econometrics, but I'll just say that we did it in a way that was sort of going cutting edge, going towards the cutting edge, reaching for something publishable. And so we have an index that sort of makes use of the modern techniques, but we try to clean up the conceptualization. So we hope we have clearer definitions for outreach and usage, etc. So for this forum, what I'd like to show is, despite everything that we've done in order to get the cleanest measure we could, given the data that we were given, thanks to BSP, they gave us the data, we find that there's still a really wide gap between NCR and the rest of the regions, and between the rest of the regions and BARM. So consistently on top are NCR, Central Visayas, and Calabarzon, and some consistently lagging are BARM and Eastern Visayas. So despite all the econometrics we did. Now, we did the micro data analysis, and we expect these correlations. Okay, we expect the index to be positively correlated with things that are positively correlated with education and income. Okay, we said education and income are the barriers. So when we look at the index, we wanted to validate it. It should be positively correlated. So it does seem to be that way. The index is positively correlated with regional output. It's positively correlated with regional literacy. It's positively correlated with having electricity. It's negatively correlated with lower poverty. And the nice thing here is this is something that we did not have an a priori expectation of. It turns out it's also negatively correlated to inequality, meaning it comes with lower inequality. And we tried to validate it against the FIES, and we also were able to validate it. So going to the conclusions of our study, the stylized facts offer obvious policy levers, such as raising education levels in the country and creating broader programs to improve math and financial literacy, including in the adult population. Now, it may sound like an old, tune being sung all over again, but what I'd like extra to emphasize here is the importance of math. Okay, I've taught financial economics at UP for a long time, and I do know that you need to have math really for people to really understand finance. Okay, and we need it at the functional level, even at the basic level, meaning from basic education. So financial education has been shown to raise financial inclusion, and therefore financial education can be an important instrument of financial development. Okay, this is according to Groman, Klus, and Menkoff. What I also would like to highlight are the potential undesired generational effects where the elderly may be shut out of the formal financial sector for various reasons, including unfamiliarity with financial services, which further underscore the need for intervention. So it's a nonlinear relationship with age. So you have two excluded segments, the young and the old. And I hope we can take care of the young through education and the old through some kind of remedial adult education. Research has suggested, so I am responding already to Dr. Llanto here. Research has suggested that targeting the financially excluded by encouraging basic or low-fee accounts and correspondent banking, as well as consumer protection policies and use of G2P payments by government may be effective strategies for greater financial participation. And yeah, I do acknowledge that such policies already being pursued by the BSP. So I actually read the whole book, the Nobody Left Behind book. And so I guess I have another to add to my reading list, which is the ADB book that Dr. Llanto is recommending. The silver lining of the pandemic is that it has sped up the implementation of the national ID system. And this is very helpful in terms of removing the barriers to banking in terms of documentation, removing the barriers to getting financial services. Fintech, now this is me just raising a warning because fintech does seem tailor-made to address the hurdles to financial inclusion because it targets the main areas that are being raised, like distance from a financial institution, cost of having an account, having no documentation, etc. But we should also remember that economic history has shown that whenever there's financial innovation and liberalization, it always comes with a set of risks. So there's always a warning. And I know our regulators are very good at this, but democratization of credit in the US led to credit card debt and bankruptcies. Similar democratization of housing finance also in the US created derivatives, led to the creation of derivatives, leading to the global financial crisis, etc. So with today's environment serving as a breeding ground for risk, lawmakers and regulators will need to continuously strike an optimal regulatory balance to foster both inclusion and stability. So there has to be a middle ground. And I believe that this requires deeper understanding of the new financial products, services, technologies, and markets that may emerge. So in the pandemic, a lot of new ideas suddenly emerged, and we have to understand this as well as the behavior of the new players and their clients. Think Bitcoin or cryptocurrency, etc. We have a duty now to understand them. So ultimately, we believe more research is needed here at PIDS. Measuring financial inclusion at the subnational level, I think is a first step that we are making to further study other issues, not just the important causal link between financial inclusion and growth and development, if there are any, but also the important link between financial inclusion and financial stability and even monetary policy. Thank you for giving me some time. And I apologize for my
That's fine. Yeah,
poor internet connectivity.
Yeah, so that was a very substantial talk. In fact, you covered some of the Q&A questions that were already raised, and we only have a few minutes left, so I'll do my best to ask at least one question per set of authors here. And straight to you, ma'am, Dr. Debuque-Gonzales, there's a question, now you covered this somewhat. What has been the influence of a national ID on the financial inclusion rates in other countries? Just a few quick words.
It has done a lot. In Malaysia, for instance, they did well in terms of social protection because they already had a system in place, which was something that we did not have. And that has sort of delayed some of the delivery of our, yeah. So if we could have something digital, if there's another pandemic, then it would be easier to give out like the ayuda, or if you want to give out like the unemployment through SSS or the other government financial institutions.
Right. Thank you so much. And so we also give some attention now to the paper of Dr. Hazel and her colleague. Aren't the ASEAN 5 Indonesia, the Philippines, Thailand, Malaysia, and Singapore instead of Vietnam? And I saw also here in the Q&A box that Deputy Governor Sid Tuanyo Amador has indicated wanting to answer the question live. If DG Sid is still with us, would you like, ma'am, to share your screen and mic? Yeah.
No, that's all right, Jed. I think Hazel can very adequately
Yes.
answer
Hazel,
that particular point. Yeah.
thank you, DG. Yeah.
It's really
Hazel?
definitional. I think in their definition, they just included Vietnam and excluded Singapore so that you have more comparability across economic development. But Hazel can, of course, answer.
Yes, ma'am. Actually, that's our answer. We decided to exclude Singapore because it's clearly an outlier, as you've seen in figure 5. I think we showed that it's the consistent top performer in terms of attracting foreign direct investment. So we just decided to exclude it, and we clarify. I mentioned at the start of my presentation that when I say ASEAN 5, or when we refer to the ASEAN 5 in the paper as including Vietnam instead of Singapore.
All right. Oh, thank you so much. And I think we have time just for one more question before we need to wrap up. Perhaps for Dr. Fermo's team, there's a question here about the impact of BPO companies to other sectors of the economy. What would you have some thoughts on the effect to other sectors of the economy as the BPO companies continue to rise and increase in popularity?
Yes, thank you, Jed, for the question. Thank you, Sel, for the participant who posed that question. Definitely, as in any development theory, implications to differences in real wages across different sectors would have certain implications. Higher real wages, for example, in the BPO sectors would definitely result in the attractiveness or the migration of labor coming from lower wage and lower productivity sectors, such as the agricultural sector. So it would have some impact. However, when you look, and for example, when you look at the domestic content of the BPO sector, understandably, it would have very little domestic content apart from labor because it is directed to trade and tasks for exported business services. Nevertheless, I think also in development theory, we know that this can still result in higher welfare for the economy as a whole, because then it can also result to higher real wages for the entire sector or even for the entire economy eventually, as you move towards higher productivity sectors coming from lower productivity sectors. That being said, when you look at indicators extracted from the ADB Rio tables, when you go through that table in their website, they have extracted some information on domestic value added, and is showing that compared to other economies in Asia who are participating in GVCs, the domestic value added of exports in business services in the Philippines are actually increasing more so than in the other Asian economies. So this is a good thing, because then we know the advantages or benefits to the domestic sector is also better, or it is giving a higher welfare. Thank you.
Thank you so much, Laura. And with that, I wish to thank our dear presenters and reactor discussants for their substantial set of thoughts. A lot of bright minds came together this morning, aided also by a lot of bright minds from our audience. I turn over the floor now to Dr. Aniceto Orbeta Jr., President of PIDS, for closing remarks. Sir, good morning.
Good morning. Thank you. Governor Diokno, Dr. Philip Medalla, and Dr. Gilberto, Dr. Myrna, Austria, our distinguished presenters, good morning. It is my privilege to close this public research forum, which highlights some of the best ideas that we should consider as we move forward from the ongoing pandemic. Before the pandemic, we were growing by more than 6% consistently for 8 years. This is the primary reason for the unprecedented declines
in our poverty incidence. However, with the pandemic, we expect a setback in our poverty reduction. In a paper released last year by my predecessor, Dr. Cyril Reyes, she estimated that even with financial assistance or the social amelioration program, poverty incidence in 2020 will shoot up to 19.4% from 12.1% in 2018, or an additional 2.8 million for Filipinos. Meanwhile, we have the employment rate has decreased from 17.6% in April 2020 to 6.9% in July 2021. This decrease in the number of unemployed Filipinos, coupled with the declining number of COVID-19 cases for days now, bodes well for our economic recovery amid the pandemic. We must be proactive in sustaining these gains. Pandemic left a depth scar in our economy, and analysts predict that it will take years to return to our pre-pandemic growth years. What can we do then to improve the chances of sustaining the nascent recovery? As the title of this public research forum indicates, what we need are resilient legs on which the economy could stand. The presentations, our esteemed research person underscored 3 areas of growth and resilience that we should take advantage of, namely capturing more foreign direct investments, or FDI, moving towards a higher level of business process outsourcing services, such as information technology outsourcing, analysis process outsourcing, and promoting financial inclusion. The presentation about FDIs underscored the latest importance of the economic growth as a long-term investment that could generate business for the economy, create new jobs, and bring in technical know-how that could accelerate our innovation journey. But as Ms. Hazel Parcon-Santos of BSP noted, our FDI outlook has been badly affected by the pandemic. Moreover, the deterioration in macroeconomic outlook and the shift to a negative credit rating, declining credit rating, have posed increased risks to the Philippines' credit profile, making the country less attractive to investors. Meanwhile, Dr. Laura Fermo's presentation, IT-BPM, emphasized how evolving and diversifying into knowledge process outsourcing services, which are among the most in-demand jobs in the fourth industrial revolution, could increase our labor productivity and real wages. She noted how this could be made via upskilling and human capital investment and raising and maintaining our competitiveness in the global markets, as among the other strategies. On the other hand, our macroeconomic expert at PIDS, Dr. Margarita Debuque-Gonzales, showed the opportunities presented by financial inclusion as a poverty and inequality reducing strategy. Her presentation has filled a significant research gap, providing an empirical basis on the relationship between financial inclusion, economic growth, and development, especially at the national and subnational levels. The research with Mr. John Paul Corpus showed empirical evidence on the effects of factors such as education, income, employment, and geographical location on financial inclusion. They have also underscored that financial inclusion is positively associated with indicators of economic development such as GDP per capita, electricity access, and literacy, and negatively associated with poverty incidence and income inequality to some extent. Looking at the presentations allows me to give my 3 essential takeaways. First is the significance of improving our macroeconomic outlook, regaining the confidence of credit rating agencies. The presentation clearly showed that higher sovereign credit risk ratings are a decisive pull factor for foreign direct investors. Concerning this, we also need to have a good incentive package for businesses. The good news is that we have already planted the seed with CREATE Act so far as the most significant stimulus we have developed for our business sectors. With the considerable tax reduction that micro, small, and medium enterprises will enjoy, and a large corporation as well, we envision that this will invigorate our economy, enable our business to expand, and stimulate new ventures. The second takeaway that I wish to emphasize is the value of education and training to enable our workforce to shift to higher value BPO services that provide better wages and higher labor productivity. I have spent years researching education and labor policies. While we have instituted gold programs such as the K-12 and market-driven and well-targeted skilling programs of TESDA, The test scores from the international large-scale assessments such as PISA and TIMSS indicate we fell short in ensuring that our students have quality education. In addition, the learning loss from relying on remote learning because of the pandemic adds to our economic problems. My third and last takeaway is the need to expand and deepen financial inclusion. We can do this by increasing access to schooling, expanding employment opportunities, making financial services more accessible, particularly to geographically isolated and disadvantaged areas, and enhancing financial literacy among the poor and the marginalized. The Philippine ID system, or PhilSys, creates a window of opportunity for the unbanked to have access to financial services and be part of the financial system. At the same time, the Pantawid Pamilya Filipino program facilitates the beneficiaries' inclusion into the financial system and raises their awareness of proper financial management. We need to capitalize on these bright spots, but clearly they are not enough. We need to strengthen our health system, build resilience, and enhance the competitiveness of our agricultural sector, improve our physical infrastructure, and address the digital divide. It has aimed to help our government develop resilient legs for economic recovery in the post-pandemic era. In closing, let me take this opportunity to express the Institute's most profound gratitude to BSP for collaborating with us on this timely research forum. Thank you, and I wish you all a safe and pleasant day.
Thank you also, Dr. Orbeta. Ladies and gentlemen, this brings our event to an end. May we invite all participants to answer a short survey, the link for which shall be flashed and will be sent to your registered email addresses. This will help us improve our plans for future events, to which, by the way, we already invite you in advance. So please watch out for announcements from time to time from the social media and web pages of the PIDS and BSP. A good day to all. Thank you. Thank you, sir.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you, ma'am. Thank you.
Hanggang kaway-kaway lang tayo.
Thank you, everyone.
Kayo na susunod.